Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo and Investing.com, and welcome to our webinar, Getting a Handle on Technical Analysis. Now, tonight's class is sponsored by Alvexo, one of the world's leading providers, and if you like, you can open a demo account while we're in class tonight and follow along using their platform. If you go to www.alvexo.com, you can just put in your email address, your name, and pick a password, and you'll have a demo account open for you. Now, you know you're trading with one of the best companies out there that have regulatory approval throughout the globe. They are regulated by a lot of government regulators around all of Europe and the Middle East, and they are approved for Forex and CFD trading. And they offer a very unique service. Number one, they have their web trader, which has been customized and designed by Alvexo. You can trade from anywhere. You don't have to download anything. It feeds you real-time quotes, has one-click trading, all types of ordered trades like limit orders, market orders, stop-loss orders. You have extremely fast trade execution and robust security on their platform. But if you want to trade from the professionals' best, you can download the MT4 platform, which will give you multiple order execution types, give you chart-based trading, and you're able to build in your own alerts and signal system and automate some of your own trading by yourself. You'll also get the free signals from Alvexo. They have an 88% accuracy rate. They're free of charge, and they're issued to you right on the platform. Now, tonight's class is being recorded. If you wish to see a recorded copy of this class, give us about 24 hours to get it hosted, and then go to www.investing.com, right where you register for this class, and look under webinars and then webinars on demand, and you'll see all of our recorded versions of all the webinars that we offer. Now, because Alvexo is a regulated provider, I've got to give you a risk warning. So let me read that, and then we'll move on. Trading Forex, CFDs, or spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. So let's get started with getting a handle on technical analysis. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. Now, the field of technical analysis is extremely broad. Many people think of technical analysis as simply as technical indicators. You know, MACD, stochastics, RSI, moving averages. But that's only one portion, and those are called technical indicators. But that's a very big portion. But we also have technical analysis. It's virtually any field of analysis that is done on your charts and done with the use of price on your charts, because price is always your first indicator. Price never lies. So you never use any type of technical analysis without using it in conjunction to what the price movements are on charts. Now, technical analysis can use simple patterns on charts. These are triangles, channels, wedges. You've heard of them all. There's head and shoulders, there's flags, there's pennants, there's teacups. There's all kinds of wacky things out there, but they're all patterns that are seen in price movement on a chart. Then you have indicators. Indicators are your secondary wall of defense. Indicators should never be your primary source of decision making. Indicators help you understand or interpret price movement. So, to the inexperienced eye, a financial chart looks like an unpredictable line with a jumble of colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where share prices or asset prices could be headed next. Now, tonight we're going to look at some of the most common indicators and try to explain to you what they mean and what groups they fall into. Because most traders don't have any understanding of how indicators are separated. They say, their buddy told them to use RSI and their other buddy told them how stochastics is great, but they really don't know much about them. They know when they see this on a chart and this happens, do this. But you need to understand how to build your own trading strategies. You need to understand where these indicators come from and what they form. Now, the main similarity between technical analysis indicators is that they all use security prices, the open, the high, the low, the close, the volume in their calculations. This small number of variables has produced hundreds and even thousands of different indicators. Now, technical indicators fall mainly into two categories: leading and lagging. Now, the names are basically tell you what they are, but I guarantee you most of the people in the audience tonight don't know the difference between a leading and a lagging indicator and don't even realize that they fall into these groups. Leading indicators are those who lead price movement. They're in front of the price. They give a signal before the new trend or reversal occurs. Lagging indicators are those who follow the price action. They give a signal after the trend or the reversal has started. Indicators, though, from both of these categories belong to one of the following types. Now, all indicators, or almost all, I can't say everything because it's not finite, but almost all indicators fall into what we call the 5 types of indicators. That's trend, momentum, volatility, and volume indicators. Now, these indicators are used for alerts, to predict, and to confirm. So a technical indicator is a mathematical calculation that can be applied to an asset's past patterns like price, volume, and even other technical indicators. We do have indicators that are indicators of indicators. Like when we talk about MACD, MACD is a derivative that's 4 steps away from the original price. It's a derivative of a derivative, or an indicator of an indicator. Technical indicators do not analyze any part of fundamental business. Technical indicators don't rely on news. They don't care what the news is. They don't care what the headlines are. They don't care what Mario Draghi said. They don't care that North Korea set off a bomb. They don't care that the U.S. just passed a tax rule. They don't care that Apple had incredibly high earnings, because technical indicators and technical traders believe that all information, everything and anything that can be known that will affect an asset's price, is already factored into the price. So that means automatically that these technical indicators are behind the market, because the news had to happen. The markets had to react for the technical indicators to have it factored in. But they still work very well, because you need technical indicators to help see when price is moving in a direction and will sustain that direction or is about to reverse itself. And one of the main categories these indicators fall into are called trends. Not trend lines, but trends. Identifying trends over a different time frame are useful because it helps weed out all the noise of daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit so long as it's shown to be consistent. Now, there's a difference between trends and trend lines. Trend line is an indicator that tells you where price should be moving on a line. A trend is a general direction of price movement. So a trend line has strict rules about how it's drawn and gives you support and resistance, where trends just tell you that the price is moving up or down or sideways. You can have strong trends, weak trends, developed trends. But trend traders use a number of different indicators to help them figure out what kind of trend an asset is moving in. One of the most popular of these indicators is a simple moving average. And moving averages fall into the area of technical analysis. Now, a moving average is simply a time period and a number of time periods divided by the number of time periods and averaged out. So in other words, if you want to see and we refer to them as 20-day moving averages or 30-day or 10-day moving averages. But when we talk about day, we should be saying 10 time frames moving average because it's based on your chart. If you're looking at a one-day chart and you're looking at a 20-day moving average, you're taking the average close price of the last 20 days, adding it together and dividing it. But today, because we're all using 15-minute, 30-minute charts, it would be a 20-day moving average using a 15-minute chart would be the 20 last 15-minute segments. And then you take those 15-minute closes, add them together for the 20 periods and divide by 20. So you should be properly saying a 20 period or a 20 time frame moving average, but we tend to just say a 20-day or a 50-day or a 30-day. Now, what a moving average is, it is about the most base technical indicator you can use. It is actually put on your chart over top of the price, and moving average takes the noise out of your price. Now, we have simple moving averages, we have weighted moving averages, we have exponential moving averages. There's lots of trading strategies that use a 30 and a 60-day, and when one crosses over the other, it gives you something. Or there's an indicator like MACD or ADI that are combine multiple moving averages to tell us something about the market. But these all fall in what we call trend indicators. Then we have, and we'll come back to trend indicators in a bit. We're going to come back to all these once we go through the definition of the categories of indicators. Then we have volume. Now, of course, is the measure of the total number of shares or contracts that trade in a given period. Where volume really comes in handy is for confirmation. Now, all charts give you the ability to put volume on the bottom chart by clicking a volume button. Now, common sense tells you when price is moving up or down in a definite trend and the traders believe in the price movement, what would you expect to see? You'd expect to see volume climb. So when you see one indicator and it's supported by volume or a chart pattern or a reaction to a support and resistance line, and it's supported by volume, it tells you that the traders believe in that. If volume's steady, and then you have a decline in volume also. So volume is very important. Many traders use volume to confirm the conclusion from another type of indicator, such as a trend. Sometimes market conditions or a lack of liquidity alone can temporarily drive an asset's price higher or lower. However, these moves are often on relatively low volume and can be short-lived. So sometimes you see a big peak in the market or a big decline in the market because the market's reacting. When you don't see the volume, it's usually because they're very short-lived and there's not any belief in them except it's a peak. It's a perk for the moment. On the other hand, if a stock makes a big move on extremely high volume, that's a reliable signal that there is major buying or selling going on, and a move should be taken seriously. Okay, now this is volume. Now there are indicators that use mathematical calculations combining price movement, opens, highs, lows, and closes, and volume to give you some kind of prediction. I use straight volume, but there's things like Chaikin money flow, on-balance volume, demand index, and force index that will help you see or predict or interpret how the volume is moving. Next, we come to the third category of different indicators. And it's a very important category, and it's my favorite, and that's momentum. Momentum indicators are like speedometers for traders. They show how fast an asset is moving in a given direction. These indicators are typically displayed as oscillators, excuse me, which fluctuate above and below a baseline to indicate how much positive buying or negative selling momentum an asset might have. Now, remember, we have indicators. Let's go over. Let me pop up some live charts onto your screen here. Give me a second here. Okay, so let's go look. We have the euro US dollar right here on the chart. We're looking at a 1 hour chart. So if we put our moving averages on a chart, so let's go to moving average. We'll pull one up here. I click on a moving average, and let's make it a little bit bolder so you can see it better. We'll make it bright red. And that is a simple moving average. Okay. As you can see, we dropped on the chart, the input is a 9-day moving average. So let's use a 20, let's use a 30 and a 10 and a 30. Okay, so we're going to use a 10-day moving average. Okay. And that simply removes the noise. Okay. Now, if we use that together with another moving average, and we'll make that a 30-day moving average, and we'll make that, let's make it bright green so you can see it. Now we have started building together a moving average strategy or a moving average indicator, and what we would be looking for, and I'm not telling you to use this because you need to learn about moving averages, but this is a simple moving average, and we would look for crossovers when the longer period moving average moves across the shorter period moving average, or just the opposite. When we have these crosses, they're trying to tell you something. Tonight we don't have time to understand or learn and explain to you how moving it, because that's a whole class to itself. But this is a simple indicator that is a technical, it falls under technical indicators. Then we have the other ones we were just talking about, which is volume. And volume is automatically dropped for you on the bottom of your chart. So we can see volume down here. And let's see if we can make it a little bit brighter. So now we have volume on the bottom of our charts. So now we're starting to build trading strategies. So now we're starting to build trading strategies that we can use. But these are different types of indicators that fit in different categories. Because then we also had what was called MACD, okay, or moving average convergence and divergence. And we can drop that on our charts. Now, this is another type of indicator, but now you see we have the indicators that are dropped on your chart and go overpriced. You have ones that are placed underneath, and you have ones that fall at the bottom of your chart. Now, the category we were just talking about, okay, were the momentum indicators. And let's go put RSI on this chart because it's a little bit different. Relative Strength Index, which is a momentum indicator, which you see down here in the purple range, is also known as what we call a bounded indicator, and it's also in a field that's called an oscillator. The reason being is it will be calculated, whenever it is calculated, its value will always come out between 0 and 100. And it has a range that is trying to tell you something. The only type of a bounded indicator, because it's bounded between the 0 and 100, the areas between the 70 and the 100 and the 0 and the 30 are the only areas in which it's trying to tell you something. Now you have a lot of them that are in the 0 to 100 range, but you have some that are between 0 and 2 or 0 and 5, but they're bounded in that range. So what we have just indicators that put on the bottom of your chart. We have bounded oscillators. We have indicators that drop over top of your charts and stuff that's placed at the bottom of your charts. These are all different types of indicators and also from different categories. But let's go back to the PowerPoint and let's go back through this a little bit more. So right now we are talking about momentum indicators. And these momentum indicators, a good deal of them fall into what we call oscillators and then bounded indicators. Now arguably, they are the most popular of the momentum indicators, and the most popular overall, especially in today's market, is RSI, Relative Strength Index. This is what I was just showing on the bottom of the charts. RSI is represented by a chart that tracks the asset's price in a scale of 0 to 100. Most RSI charts have lines at the 30 and the 70 mark. If the asset moves above 70, it's considered overbought, meaning there's too much buying pressure. And if it falls below 30, it's the opposite. So we do have indicators like Chandre's momentum indicator. We have Williams percent R. Okay, we have stochastics. Now, the reason you have to know these indicators and what fields they fall into is because a lot of traders I'll see, or they'll send me something in email, or I'll see their charts online, and they're all using several types of the same indicators that give them the same information. And you should know when you're looking at your indicators. I have one that's telling me momentum. I have one that's telling me volatility. And I have a different one that's telling me trend reversals. Because you don't need 3 telling you the trend's about to reverse. You need to know what categories are so you can actually interpret them and then use them in a trading strategy. Because now we come to a very important one, and especially for CFD trading. Okay. And cryptocurrency, it needs it desperately, and that's volatility. Volatility is a measure of how large an asset's movement is in a given period tends to be. When an asset makes large moves in a short period of time, it is considered to be volatile. Volatility is a very important indicator for traders because volatility makes it easier to profit due to price inefficiencies. Without volatility, trading opportunities would be very limited. Like trading in the stock market is very, very limited. Apple stock doesn't move that much in one day. Okay, it has very little volatility. Now, sure, there's penny stocks, small stocks, and other stocks that could, but overall, they don't. Volatility is so important for traders that the Chicago Board of Options Exchange has an index called Volatility Index, the VIX, which is world known as the fear index. In addition, the VIX traders use volatility metrics such as average true range, Bollinger bands, and envelopes as trading indicators. But what else could volatility help you see? What is so important about understanding volatility? Well, if you have to place your stop loss and you're putting your stop loss in a very volatile market, you need to know you got to put it farther out, or otherwise you're going to get stopped because the markets are volatile. So it helps you understand what's happening. Now, the fact is, even though we have these 5 categories, they actually break into 10 different groups because we have leading and lagging. And this is also important. You have to know which of these indicators are predicting and which ones are telling you after the fact. So like moving averages are lagging. A simple moving average, because they have to fall after the numbers have been calculated for the market. But a moving average crossover can be a leading indicator. But also MACD, moving average convergence divergence, is also lagging. But lagging doesn't mean it's bad. The lagging doesn't mean you missed a trade. If you imagine one indicator, which is a leading, it will tell you price should be reversing. Okay. Or a lagging one is telling you price did reverse. because you never know, because price is moving steadily up and down, up and down, up and down, up and down. You'd like to know when it's bouncing down after it's been moving up, whether it's just bouncing or whether it's actually now reversed. So there's not goods and bads. A lagging indicator, just because we think lagging is behind the market, isn't bad. It's just telling you that that movement is a confirmed reversal. Okay. So remember, leading gives trade signals when a trend is about to start, where lagging are those that follow the price action. To try to predict price by using a shorter period in their calculations, thereby leading the price movement, these popular leading indicators are stochastics, MACD, and RSI. Okay. For lagging indicators, they give signals after the trend or reversal has started. Use them to determine a trend, and the most common lagging indicator is the moving average. Okay. Now, these technical indicators that we talked about measure the direction and the strength of a trend by comparing price to an established baseline. So, for instance, moving averages are used to identify trends and reversals, as well as to set up support and resistance lines. Moving average convergence and divergence are used to reveal changes in strength, direction, momentum, and duration of a trend. So moving average, divergence, and convergence, which is one of my favorite indicators, and I like saying it MACD, or moving average convergence divergence, has many features to it and fits in several categories because it's made up of several different lines, and you have the ability to find a whole bunch of information in that indicator. Now, you can come to our class. We have a whole 1-hour class just to MACD. Now, these indicators are designed to show traders and investors the trend or the direction that an asset are trading. The trend of an asset can either be downwards, upwards, or no clear direction. Trend followers are examples of traders who use trend indicators to analyze the market. Now, if you see an asset moving up and you're thinking about getting, whatever reason you're thinking about buying, wouldn't you like to know that that trend is continuing or that trend is very strong? But that's what the trend indicators give you. Okay. Then momentum indicators, some of the most popular ones are stochastics, commodities channel index, CCI, or relative strength index. But look at that, they're all leading indicators because RSI and stochastics are bounded indicators, and when the price moves into the 70 to 100 or the 0 to 30, it's telling you the markets are overbought or oversold. It's telling you there's too many buyers or too many sellers in the market. The price is too high or too low. But it doesn't tell you exactly when they're going to turn, because an overbought market can stay overbought for a while longer. Doesn't mean it's going to reverse at the moment. So if you're in an asset, you'd like to know that it's overbought or oversold. And if you're looking to get into an asset, you'd like to have this leading indicator telling you we think it's overbought, because you then have to wait for the markets to indicate. So it helps you exit the markets at the right point and prepares you or gives you a signal for future price movement. So these technical indicators may identify the speed of a price movement by comparing the current closing price to previous closes. So you have stochastics, CCI, and RSI. The momentum indicator measures the speed at which the value of a security is moving in a given period. Momentum traders focus on stocks or assets that are moving significantly in one direction and high volume. So wouldn't you like to know that? Most of us trading CFDs and Forex are looking for exactly that, because we're looking for short-term, strong movements. So when an asset has strong momentum and is pushing up or down, like Bitcoin's been pushing all the way up, it's got a lot of momentum. We'd like to know that that momentum is strong enough that it can continue on and we can trade in that direction. So as you can see, momentum indicators are essentially composed of oscillating indicators that are usually used to determine overbought or oversold positions. So if you saw Bitcoin soaring up to 11.5, and you were thinking about getting in, or you were in the market and worried about when to get out, when you would see the momentum indicators telling the market's overbought or oversold, you would either be prepared to enter or exit the market at that point. And then volatility indicators, which we talked about before. Those fall into Bollinger Bands, ATR, and standard deviation. Bollinger Bands is one of the best indicators in the marketplace. Bollinger Bands compared with stochastics and MACD will give you an entire trading system, and they are great indicators. Bollinger Bands is a lagging indicator, but these Bollinger Bands are actually dropped directly on a chart. Let's show you this. And they are said to have all the information a trader needs within the band. So let's get these moving averages off the chart. And we go up here to Bollinger Band and indicators. And Bollinger Band is so popular, we're just going to click on Bollinger Bands. And this is what a Bollinger Band looks like. Okay. The width of the Bollinger Band tells you how volatile the market is. And all the price movement for an asset is said to be contained within the band. So when you see the price fall to the bottom of the band, that's expected to be the low where the trend will reverse and is your support area, and it should move to the top of the band. It will also help you set your stop losses because you're also seeing the movement within the band. So Bollinger Bands can be a very, very good indicator, give you a lot of information, but they will also help you actually visually see the volatility of the markets by the width of the bands. And then we can add on to that, there's a Bollinger Band %B, which is actually calculating the width of the bands or the bandwidth. And we can actually see that moving in an indicator which is telling us how volatile the markets are, as well as some other pieces of information. So in order to start using technical analysis, unfortunately, you have to know all this stuff. Okay, because too many traders out there try to use somebody else's system without understanding what they are. So I have friends who tell me, well, I use MACD stochastics, and when they do this, when both of them are in the 70 range, I'm going to buy or sell. They don't understand that this is, they don't understand why. Somebody's told them these are the rules. Okay. And it just doesn't work that way. You might get some successful trades, but when you can understand the indicators and combine them with the right indicators and understand what areas they fall in, you can then make your own trading system, be your own trader, and understanding your own strategy. And that is what's ultimately important. So volatility is so important in trading that you can find several indicators that measure and generate signals. The volatility is the relative rate at which the price of a security moves up or down. And we have them on balance, volume rates, and Chaikin. Okay, you can use any of these. I just simply use my volume chart at the bottom of my chart. I like to see the volume and see it. I don't need an indicator. But the volume of trades is a very important component of trading. It is an example used to confirm or infirm a continuation or a change in a direction. Many indicators are also based on volume, because they show us, when we combine those with overbought and oversold like we get from RSI, we can combine these into trading systems. And we can start looking for what we call convergence or divergence, or overbought and oversold. And there's lots of things we can do with these indicators. Okay. And lots of interpretations once we know what groups they fall in and we're picking the right ones. So indicators serve three broad functions: to alert us, to confirm, and to predict. An indicator can act like an alert to study price action a little bit more closely. If momentum is waning, it may be a signal to watch for a break of support. Or if there's a large positive divergence building, it may serve as an alert to watch for resistance breakout. Indicators can be used to confirm other technical analysis tools. If there's a breakout on the price chart, a corresponding moving average crossover could confirm the breakout. Or if a stock breaks support, a corresponding low on the on-balance volume could serve to confirm the weakness. Some investors or traders use indicators to predict the direction of future prices. Now, remember, indicators indicate. They may sound straightforward, but sometimes traders ignore the price action of the security and solely focus on indicators. Indicators filter price action with formulas. As such, they are derivatives and not directly reflective of price action. This should be taken into consideration when applying analysis. Any analysis of any indicator should be taken with the price action in mind. What is the indicator trying to say about the price action of a security, and is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signals should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it may be a false signal. So the first thing a good trader relies on is eyeballs and looking at price movement on a chart. So here we have a very simple trading system. Now, we have candlesticks. We've seen that a symmetrical triangle has developed. Okay. We see volume down below. We have on here our Fibonacci retracements, and what we're looking for in this place. Now, there's standard formulas with chart patterns, and basically it says that the momentum of a breakout should equal the height of the initial move. So in other words, we take this initial move right here, we can measure that, and that should be the breakout of the momentum when the price breaks out of the symmetrical triangle. The symmetrical triangle falls under area of technical analysis called chart patterns. This is looking for particular patterns that develop in price on a chart. This is using your eyeballs to look at a chart without looking at indicators at this point. So when price is moving into an ascending triangle, a descending triangle, symmetrical triangle, moving into a wedge, moving into a head and shoulders, okay, we're looking for a price, and what we see is that the price is getting pent up here. It's getting, at some given point, somebody's going to have to take control, or the buyers or the sellers are going to break out. If we get a bullish confirmation, which is what we're expecting, is the price should have the momentum to push it to the equal level of the height of the previous movement. And this will help you set your targets. Okay. But price action should be first what you're looking at. So we have entire classes on just trend interpretation support. We have a class on support and resistance. We have a class on trend interpretation, and we have a class just on chart patterns. Okay. But as you can see, you can get as complicated. Just want to get my markings off here so you can see this a little bit easier as possible. But all of this is based on price on a chart. Then we have our indicators below, and we haven't even talked about things like Fibonacci retracement, GAN fans that are dropped on your charts to give you different levels of support and resistance. We haven't talked about simple support and resistance lines. But see how we're using our indicators down below. We have RSI, and what do we have at this point? We had a divergence. As you see, we had price moving up, but the RSI chart was moving down. It was making lower lows while the price chart was making higher highs. So here we had a divergence between that price. Now what we have is we actually have two reaching highs, and we're looking for an entry point that we would have entered this trade. We're looking for several different ones. But this is a combination of using your indicators as well as your chart patterns as well as price action on a chart. But this is why you need to learn all of these indicators and where we fit. Here's a simple charting method. We have our trend lines. We have our stochastics down below, and we're using candlesticks, and we are looking for the bounce off of our 50% Fibonacci retracement, and this is what we're looking for. We would be looking for a sell entry, as we just got when it broke below. Our stop loss would be up here at their last candlestick high, and this would be where we would set our take profit point, which would have been the previous swing low. And these are simple little formulas with simple little indicators, but there's different ways that different traders try to evaluate the markets. But you have to first understand where they fit, what field they're in, and how you would combine them together into a trading system. So remember, without technical analysis, you can't make decisions. Fundamental analysis will help you predict whether Apple price should go up, whether the euro should go down, whether Bitcoin's going to climb. But it doesn't tell you how far it's going to climb. It doesn't tell you when it's too heavy. It doesn't tell you that it's got the momentum to keep going. And it doesn't tell you where your take profit point should be. It doesn't tell you where your stop loss should be, because all it's telling you is, okay, Apple just had a very good quarter. Their earnings were higher, or somebody came out with a good report, or Mario Draghi just said something to send the euro climbing, or the tax bill passed in the U.S. Senate, so that sent the S&P soaring. Well, you knew the S&P was going to rally, but at what point do you want to get into it? What point do you want to get out of it? And where do you have to put your stop loss to cover the swing of the market? You're not going to get that from fundamental news. You're going to get that from your indicators. So when you want to look at Bitcoin still rallying, how would you know that the markets are still going to head up, or are they getting too top heavy, and are they going to fall down? Well, look at our simple coin here, this Bitcoin Cash, and look at that rally. Okay. Now look where we are now. Okay. It's still way, way up, but is it going to continue up, or is it going to continue down? Okay. Is the market too heavy or too weak? All of this comes from technical analysis, and you have to break it down and learn each piece and part of it. It's not complicated. You can master it if you put a little emphasis, because you don't have to have complicated trading systems. If you can look at price and determine what's happening there, you have one or two indicators. You know where your support and resistance lines are. You evaluate your trend and look for something that's going to give you an alert. Some of these people come up with these complicated systems that have hundreds of different things on the chart, like this guy. Okay, it's got so much going on in this chart, I don't know if you'd ever get a good trade in. The simple fact is, if you have too many indicators, they're all going to point in other directions. Okay. And basically, when you have too many of them, you're just almost guessing. So you have to have one hardcore system, one hardcore way that you're going to interpret the markets and understand what it's trying to say to you. And also remember, we're short-term traders. We're day traders. We're a couple day traders. We're looking at small movements and small prices in the market. It's a different thing if you're a swing trader, if you're a stock investor. You're looking for different things. And you have to understand which of these indicators fit those type of markets. And on that note, I'm going to say goodnight to you all. I hope you learned a little bit tonight. Go to www.alvexo.com. They have a great academy. They have all types of learning material. They have all types of classes, and they have all types of videos for you to watch and learn, ebooks, everything you need. Plus, they have one-on-one training that will help you explain all of these away. So thank you very much. And again, go to www.alvexo.com, open up a demo account, look at their academy, watch some of the videos, read some of the things. They have some great information, and see where you can go from here. Thank you very much, and we'll talk to you again real soon. Good night now.